On Sunday evening, the 19th of March 2023, Swiss Finance Minister Karin Keller-Sutter held a press conference that no one expected to ever see. She announced that Credit Suisse, 167 years old, one of the 30 most systemically important banks in the world, the institution that Switzerland had built its financial reputation on, had been sold. The buyer was UBS. The price was $3.25 billion. The deal had been struck over the previous 48 hours. Shareholders had not voted. They had not been asked. At its peak in 2007, Credit Suisse was worth 100 billion Swiss francs. On the evening it was sold, it was worth 3. The Swiss authorities had told both banks earlier that day in a meeting that Credit Suisse's CEO and chairman attended that the merger would happen before Asian markets opened on Monday. Their exact words, later confirmed by reporting, "You will merge with UBS and announce Sunday evening before Asia opens. This is not optional." That weekend, the Swiss government activated emergency law, bypassed standard shareholder protections, wiped out $17 billion in additional Tier 1 bonds, and committed CHF $209 billion in public support to stabilize the transaction. This is not the story of one bad weekend. This is the story of 15 years of decisions that made that weekend inevitable. On Sunday evening, the 19th of March 2023, Swiss Finance Minister Karin Keller-Sutter held a press conference that no one expected to ever see. She announced that Credit Suisse, 167 years old, one of the 30 most systemically important banks in the world, the institution that Switzerland had built its financial reputation on, had been sold. The buyer was UBS. The price was $3.25 billion. The deal had been struck over the previous 48 hours. Shareholders had not voted. They had not been asked. At its peak in 2007, Credit Suisse was worth 100 billion Swiss francs. On the evening it was sold, it was worth 3. The Swiss authorities had told both banks earlier that day, in a meeting that Credit Suisse CEO and chairman attended, that the merger would happen before Asian markets opened on Monday. Their exact words, later confirmed by reporting, "You will merge with UBS and announce Sunday evening before Asia opens. This is not optional." That weekend, the Swiss government activated emergency law, bypassed standard shareholder protections, wiped out $17 billion in additional Tier 1 bonds, and committed CHF $209 billion in public support to stabilize the transaction. This is not the story of one bad weekend. This is the story of 15 years of decisions that made that weekend inevitable. Credit Suisse was founded in 1856 by Alfred Escher to finance Switzerland's railway expansion. For most of its history, it was exactly what it appeared to be: a serious, conservative Swiss bank, managing serious, conservative Swiss money. That reputation began fracturing in the 2010s, not from one catastrophic failure, but from an accumulating series of decisions that, taken individually, might have been survivable. Together, they weren't. The Tuna bonds. Between 2013 and 2016, Credit Suisse arranged approximately $2 billion in loans to state-owned companies in Mozambique, nominally to fund a tuna fishing fleet and maritime surveillance infrastructure. The project was presented to international investors as a legitimate development initiative. It wasn't. A significant portion of the funds investigators would later identify, more than $200 million, was diverted in bribes. Some went to Mozambican government officials. Some went directly to Credit Suisse bankers. The loans were backed by state guarantees that Mozambique's parliament had never approved, and which the government had deliberately concealed from the International Monetary Fund. When the scheme collapsed in 2016 and Mozambique defaulted, the IMF froze its support for the country. The economic consequences were devastating. A subsequent study estimated the scandal cost Mozambique $11 billion, equivalent to the country's entire GDP for the year, and pushed 2 million people into poverty. Credit Suisse paid $475 million in fines to US and UK authorities in 2021. It pled guilty to wire fraud. It agreed to forgive $200 million of Mozambique's debt. The bank said it was satisfied with the completion of proceedings. 2 million people were in poverty. The bank was satisfied. The spy scandal. In 2019, internal investigations revealed that Credit Suisse had authorized surveillance of Iqbal Khan, its departing head of wealth management, who was leaving to join UBS. The bank hired private detectives to follow him through the streets of Zurich, apparently concerned he would poach clients and colleagues. The operation was exposed. The bank's CEO at the time, Tijane Thiam, who denied knowledge of the surveillance, resigned. FINMA's subsequent investigation found not one, but 7 separate surveillance operations between 2016 and 2019. March 2021. 2 collapses. 1 month. A combined exposure that would leave Credit Suisse looking uniquely, almost incomprehensibly, exposed. Archegos Capital Management was a family office run by Bill Huang, a former hedge fund manager who had previously been barred from managing public funds by the SEC. Archegos had built enormous leveraged positions in a small number of stocks, primarily media and technology companies, using total return swaps, a derivative structure that allowed it to take on massive exposure without appearing in standard ownership filings. When those positions went wrong in late March 2021, Huang's counterparty banks called their margin. Archegos couldn't pay. The fire sale that followed was one of the most chaotic forced liquidations in Wall Street history. Multiple banks had exposure to Archegos. Goldman Sachs lost relatively little, having moved quickly to liquidate. Morgan Stanley contained its losses. Deutsche Bank escaped with minimal damage. Credit Suisse lost $5.5 billion more than any other bank from the same collapse at the same moment. A subsequent internal review by law firm Paul Weiss described the losses as the result of a fundamental failure of management and controls, and documented that the bank had willfully ignored more than 100 internal risk flags. 3 weeks before Archegos, Greensill Capital had collapsed. Credit Suisse had sold its clients $10 billion in supply chain finance funds linked to Greensill, assuring them the products were low risk because the underlying credit exposure was fully insured. When Greensill failed, the insurance turned out to be inadequate. Clients were told they might not recover the full value of their investments. The bank buried its internal review of what had gone wrong. $5.5 billion from Archegos, $10 billion in client funds frozen from Greensill. in the same month from the same bank. The most controversial element of the Credit Suisse rescue was not the price. It was what happened to the AT1 bonds. Additional Tier 1 bonds, also called contingent convertible bonds, or COCOs, are a form of debt designed to absorb losses in a banking crisis. They rank below ordinary bonds, but above equity. In a standard bank failure, shareholders get wiped out first. Then, if losses are still uncovered, AT1 bondholders absorb the remainder. In the Credit Suisse rescue, that order was inverted. Swiss authorities wiped out $17 billion in AT1 bonds completely, while Credit Suisse shareholders received something. $3 billion in UBS stock, not zero, something. Bondholders who had bought what they believed was a relatively senior instrument safer than equity, in theory, received nothing. Shareholders received stock. The Swiss regulator, FINMA, argued that the bond contracts contained specific clauses allowing a full write-down when extraordinary government support was provided. Bondholders sued. In October 2025, the Federal Administrative Court of Switzerland ruled that the write-off had been unlawful. The immediate consequence was a global repricing of bank AT1 bonds. If Swiss authorities could unilaterally invert the standard creditor hierarchy in an emergency, the entire AT1 market, worth roughly $275 billion globally, had to be reassessed. Spreads widened. Questions that had never been asked were suddenly urgent. As for UBS, it absorbed Credit Suisse and almost immediately recorded the largest quarterly profit in banking history, $29 billion, in the second quarter of 2023, largely because the assets it had acquired were worth far more than the $3.25 billion it had paid. The Swiss government's guarantees were repaid in full by August 2023. The public, technically, lost nothing. The Credit Suisse collapse is often framed as a story about a bank run, about the speed and fragility of confidence in a digital age, about how a single comment by a Saudi investor on a March afternoon could detonate 167 years of institutional history. That framing is not wrong, but it is incomplete. Credit Suisse did not die on the 19th of March 2023. It died in 2013, when its bankers accepted kickbacks in Mozambique. It died in 2016, when it buried a risk report on Greensill. It died in 2021, when it ignored more than 100 internal warnings on Archegos. It died every time a culture that prioritized short-term profit over basic judgment was allowed to continue unchallenged. The weekend was just when the rest of the world found out. 167 years, 37 hours, sold for less than the price of a mid-sized tech startup. And the people who made the decisions that caused it, the ones who took the fees, signed the reports, approved the trades, walked away, in most cases, with their money. That's where the money really went. This was Dark Ledger. Subscribe if you want to know where else the money really went.